Good morning, everyone. I'm very excited to be hosting this event for you all this morning. My name is Thiessen Thompson, and I'm the Business Development Associate at the Machel and Associates Wealth Advisory Group here at National Bank Financial Wealth Management. I've worked in the industry for about 4 years now, and been with Mike at National Bank Financial since last January. Now I'll pass things over to Mike, who is our Senior Portfolio Manager on the team, and will explain a little bit more about his role and how we help clients. Mike, take it away.
Thank you, Thiessen. Good morning, everyone. For those of you who do not know me, and I do know a few of you on the call today, I am Mike Machel, Lead Portfolio Manager and Wealth Advisor with the Machel and Associates Wealth Advisory Group at National Bank Financial Wealth Management. National Bank Financial Wealth Management is a division of National Bank of Canada. Give you a bit of background, we've been around since 1902, and we manage $170 billion of our clients' wealth. I personally have been a chartered financial planner for the past 24 years, and our practice and our team focus helping our clients in four key areas that we believe are the cornerstone of wealth management. Number one, tax planning. Number two, investment management. Number three, estate planning and wealth preservation. And finally, number four, financial planning. In our team, we deliver customized, unique, and thought-out strategies for our clients using the most up-to-date concepts in the market. We run a few educational webinars throughout the year for our clients and centers of influence like yourself, and are excited today to have Jon Hreljac, Associate Vice President for Regional Tax, Retirement, and Estate Planning Services with Manulife Investments on the call today. The title of today's webinar is What You Need to Know About Corporate Investing to Take Your Clients to the Next Level. We hope we add value to your practice today. We know it's a busy time for you right now, but we think this will be a thought-out presentation and it will add value. There should be an option at some point during the call if you have questions that you can just type in, but I'll let Jon discuss that further. I will now hand over the presentation to Jon Hreljac.
Hey, thanks, Mike. Thanks, Thiessen. Happy to be here today. I'm going to quickly share my screen. Of course, what's a Zoom call without a PowerPoint to really, help lead the discussion. And Mike, Thiessen, as you alluded to, what we're going to be speaking about today is, a topic near and dear to my heart. What you need to know, what you need to do about corporate investing and really making sense of corporate taxation. This presentation typically is geared towards advisors, even to end user clients. So I understand the audience today is accountants, but really, even as an accountant, I think some of the key speaking points here are going to add value in terms of how you position corporate investing, tax efficiency, and taking advantage of the corporation to invest with, working with an advisor, kind of hand in hand, quarterbacking a client's situation. So again, some of this stuff may maybe be review for those on the call who have a lot of experience in taxation. Some of the stuff might be newer. And anyways, in a couple of the, at the end of the day, take away a couple of tidbits as we walk through this presentation. So every time I do this presentation, I like to kind of blast everyone with the maximum marginal tax rates, the tax rates where we sit today in 2025 in Manitoba. A couple speaking points here. Again, accountants on the call, you're probably very familiar with these tax rates. Frankly, though, I can guarantee you a lot of your clients are not, and they simply don't know the difference between personal taxation, corporate taxation, and the opportunity. So we want some high-level speaking points here. Obviously, from an individual perspective, individuals are taxed on a marginal basis. The more income you generate, the more tax you pay. In Manitoba for 2025, we're at the 50.4% tax rate for personal income, interest income, foreign dividends. I like to highlight that because I'm going to have some speaking points to that in a second. I am sitting, I highlighted the capital gain tax rate. God knows where that's going to land, with the increase, obviously the 2/3, we're going to be at 33.6%. But with all the rumblings in the news or what have you, and this, that, and the other thing, the tax not becoming, or the capital gain inclusion rate increase not law yet, we might easily see go back to the 50% inclusion rate in due course. But obviously for 2024 and a go forward after June 25th or after June 24th, CRA says they're still going to be administering it at the higher rate. So we'll see what happens there. But nonetheless, we move into the corporate world, right? We move into the corporate world. What I like to explain to clients at the end of the day is that there really is no such thing as marginal taxation per se. What we effectively have is two buckets of income in the corporate world, right? We have the active income. And I suppose in the active income world, there is a level of marginality, as I'm sure you know. So for the first $500,000, you're taxed at 9%. Over and above 500K, you're taxed at 27%. But most of the clients I deal with, advisors tend to deal with, we're dealing with a 9% tax rate in Manitoba. A beautiful rate, a beautiful opportunity, right? Because for every $100 a client generates in terms of taxable income, you're only paying tax of $9, which leaves a $91 deferral. And really at the end of the day, the way I position that is that that $91 deferral really can translate into the investment opportunity inside of a corporation to the extent that your client does not need the income personally. So really the one main takeaway I always like to explain to clients, advisors, even accountants, and you may know, if your client doesn't need the money personally, right? Or unless they can get it out tax efficiently or tax-free in any given year, they're going to be better off leaving the money inside the corporation to invest with and take advantage of the compounding opportunity inside the corp. And my next screen is going to show you a quick illustration in terms of how that works. Reason being, it's typically very expensive to get money out of a corporation. A lot of clients, perhaps you deal with, or I deal with, or, Tees and Mike deal with, they're high income earners. They have a corporation, maybe they're incorporated doctors or what have you. They like to spend a lot of money personally. So they're on that high rate personally. So for every dollar they pull out, very expensive. So if you don't need it, leave it in the corporation to invest with. Now, that being said, the unfortunate story behind that, once you start investing inside of a corporation, you're into the passive rates. And as you can see, the passive rates in the middle right-hand side of the screen really are on par with the highest marginal tax rates personally. So I always point to interest income, bad income, but easy to explain, easy to understand. Everyone knows what interest is. Interest income for every dollar inside the door from a investment perspective inside of a corp in Manitoba is taxed at 50.67%. So sometimes clients look at the screen, they think, if I'm taxed at so high inside the corporation through investing, why would I invest in through my corporation when it's basically the same marginal rate personally? But then it goes down to that narrative. You have more money working for you inside the corp. So from a compounding perspective, you will be further ahead down the road, right? Because it's expensive to get out. Now, lastly, there's that nasty mechanism, RDTOH, refundable dividend tax on hand account. Don't like getting into too much detail with respect to this. As accountants on the call, I'm sure you're familiar with it. The way I position it is a prepayment of tax. It's built into the passive investment tax rates. Those monies are ultimately refunded back to the corp when taxable dividends are paid to the shareholder, truly refunded. Now, the next slide to kind of move into some more specifics here, and this kind of really paints what I say the bottom line or the investment opportunity inside of a corporation, and really the power of compounding over the course of time, and really the advantage of leaving the monies inside the corporation to invest with. So it's an extreme example, I understand that, but it really kind of proves a point. And really this is saying, okay, if you had a client that had $1 million inside of a corporation, a retained earnings, cash built up over the course of time, and it's sitting there doing effectively nothing, and they think to themselves, should I pay it out and invest personally, or should I just simply leave it inside the corporation to invest with, right? And to pay it out is very expensive again, right? You're going to be paying a boatload of tax, about $500,000 of tax to get it out, or at the highest ineligible dividend tax rate in Manitoba, 46.67%. To pay that out, you're going to be paying about $466,000 of tax. You're only going to be left with $533,000 left to invest with, compounded over the course of time. Sure, it grows, but very slowly. That same $1 million left inside the corporation, leave it there to invest, compound over the course of time. That nest egg grows much bigger, to the tune of 1.6 million compounded at 5% over the course of 10 years. Now, extreme example again, if everything were to be blown out and liquidated at the end of 10 years, which you likely would not do, you would, dividend out slowly, maybe take advantage of marginal rates. But if you were to do that, having that corporation in play over the course of time puts your client ahead by about $144,000. So that really illustrates the power of compounding, leaving monies inside the corporation, because typically very expensive to get out. Sure, if you can get it out tax efficiently or tax free in any given year, you can do that, but typically not an option. So I just like, highlighting that point and making sure clients understand the value of their corporation and the power of properly investing. Now, to take it one step further, in terms of the opportunity, and really what I like to highlight here is just like investing personally, investing inside of a corporation, the type of income the corporation generates from a passive perspective is very, very important. And really here, what I'm basically showing is, the various different types of income you can generate: interest income, foreign dividends. And when I say foreign dividends, that basically means investing in a foreign dividend payer directly through a corporation, right? Microsoft, Home Depot, they pay foreign dividends. So you may have a stock portfolio that has, those type of investments, and you're really counting on the yield of those investments. Then you have Canadian dividends, capital gains, and return of capital. And I always, if we're in a live audience today, I would, ask the question, what jumps out to you here, right? In terms of the net investment tax rates, the highlighted numbers in red, in bold at the bottom of the screen. And I often get the answer, eligible dividends, 0%. That looks amazing. That looks great. And no doubt it does, right? And that's kind of the right answer. But really, Canadian dividends that are generated inside of a corporation from an investment perspective, you're taxed at 38.33% for every dollar inside that comes inside the door initially. The entire amount is added to the RD2H account and is ultimately completely refunded back to the corp when that Canadian or eligible dividend is flowed through to the shareholder. So the net investment tax rate is 0% from a corp perspective, because the dividend is effectively a flow through. The end user pays a tax ultimately. So that looks good. Whatever. What I like to really highlight, however, and this is really one of the main takeaways from this presentation, is the punitive effects of generating interest income or foreign dividends inside of a corporation from an investment perspective. So as you can see, the net investment tax rates, and when I say net, that's basically the permanent tax, because I'm baking out the RDTOH. I'm assuming the RDTOH will be eventually refunded. So the net investment tax rate, or the permanent tax inside the corporation, you can see with respect to interest income is 20%. And with respect to foreign dividends, it's 31.9%, even worse, which is sort of odd, because when you generate interest income or foreign dividends personally, you're taxed really at the same rate, at that 50.4%. Inside of a corporation, foreign dividends are actually worse because there's a grind to the RDTOH mechanism. As you can see, only 18.77% with respect to foreign dividends is added to the RDTOH account. With respect to interest income, you're at the 30.67% refundable amount. So long story short, CRA, finance, whomever, doesn't like when a corporation generates foreign dividends. They penalize the corporation, they grind the RDTOH, and you're paying more permanent tax. So bad income inside of a corporation, very bad, even worse than generating it personally. And this next screen really kind of paints the picture. And this is what a lot of advisors, clients, even accountants do not realize. And what this is effectively showing is that when you generate interest income inside of a corporation from an investment perspective, or if you generate foreign dividends inside of a corporation from an investment perspective, with respect to interest income, assuming your client is at the highest marginal tax rate personally, once that income is flowed through the system and in your shareholders' genes, because that's what they care about at the end of the day. Great, I have all this retained earnings. Great, I'm generating all this income inside of my corporation. How much do I actually get to keep personally? With respect to interest income, they're going to be paying 57.34% totality between the combined corporate shareholder tax rate. And foreign dividends, even worse. They're paying total tax of 63.68%. So in other words, if you had a client generating foreign dividends inside of their corporation, and if they're the highest tax rate personally, effectively that $100 translates into about $36 and change in their pocket. So very, very bad type of income to generate. Again, this type of income, if it's generated personally, they're paying maximum tax of 50.4% in Manitoba. Through the corporate system or integration system, or lack thereof integration, is the really, I call it the disintegration of integration. You're paying either 57.34% with interest income or 63.68% totality with foreign dividends. So long story short, you're doing planning with your client, they're working with their advisor. Really important to stray away from this bad type of income because the tax risk, the tax cost is so high, and they need to be investing in much more tax efficient types of vehicles inside their corp and generating perhaps say capital gains or Canadian dividends and say interest income or maybe foreign dividends for personally held investing, maybe through non-reg TFSAs, RSPs, or what have you. Because in the corporate world, very, very punitive. Now, with that being said, a couple other quick points about incorporation, pretty basic stuff here, but I'm often asked the question, hey, John, should I incorporate? At the end of the day, purely from a tax perspective, the way I like to answer that question is that if you have the ability to incorporate and you're generating lots of income and you're able to leave money inside your corporation to invest with and take advantage of that 9% rate and take advantage of that deferral opportunity, there's some great benefits there, as I already explained. If your client perhaps needs, virtually every penny they generate inside their corporation to effectively fund their lifestyle or what have you, and they remove the profit year over year over year in the form of salary or perhaps even dividends, there's going to be no benefit, okay? Purely from a tax perspective, you get the advantage by leaving money inside the corporation. And obviously, creditor protection is another reason why someone incorporates, to insulate personal liability from corporate liability or what have you. So credit protection is a different story. Obviously, it makes a lot of sense in situations, even if profits are fully removed every year. But purely from a tax perspective, there's no benefit. The benefit is leaving the money inside the corporation to invest with. And really, this screen here paints a quick picture again, just to reiterate that point. If a client generates $500,000 of income personally, extreme example, again, let's assume that 500K is all taxed at the highest rate at 50.4%. They're paying $252,000 of tax in Manitoba. That same 500K inside a corporation at 9%, they're only paying $45,000 of tax. So that $207,000 deferral, again, could translate into an investment opportunity. Again, I'm assuming extreme example, highest rates here. And I'm also assuming that full 207 is being left inside the corp. But, year over year, that can translate into a big opportunity for investing. Now, next point I bring up, because this is a question I'm often asked, how should I pay myself? Again, some basics here, but as a tax advisor myself, as I work with financial advisors throughout the country, really the answer is it depends, but I need to have an answer. But the whole concept of it depends basically hinges on, there is no necessarily right answer. It really kind of depends what the client, wants or their needs are on a go forward. So effectively from their active income, you could effectively pay taxable dividends, or you can pay yourself a salary. They both have pros and cons. Dividends are great in my mind, right? With dividends, they're more tax efficient. So by paying yourself, let's say, only dividends, you're going to get more money in your client's pocket annually because they're more tax efficient coming out. Conversely, though, there's no ability to contribute to CPP because, paying dividends is, not an earned income. And therefore, since it's not earned income, you have no ability to generate any RSP room, which again could be important to some clients. Paying a salary, conversely, not as tax efficient in terms of coming out, so less money in your pocket, but you have the ability to generate earned income, which allows you to contribute to an RSP to a certain degree. You can pay into the CPP, so you have the CPP available to you when you retire at 60, 65, 70, when you ever decide to take it. So you have a combination thereof, perhaps that could make sense. That's why I answer that question is that, if I was perhaps incorporated, I would do the combo method, which basically says, I'm going to pay myself a salary up to the annual YMPE limit for the year. And for 2025, that's effectively 81,200. That would allow me to max out my CPP contribution. It allows me to generate some RSP room, perhaps for some registered investing. Every dollar I need beyond that, I'm going to pay myself a dividend, right? A little bit more tax efficient, get some money out. Maybe I max out my TFSA, some RSP investing, perhaps dip a toe in some non-reg investing to a certain degree. But really at the end of the day, for every dollar I don't need beyond that, then I leave inside my corporation to invest with, okay? So what this is effectively creating is a variety of income buckets to draw from in the future. So you have, income diversification. You can have your, RSP available, your TFSA, CPP humming, and ultimately perhaps your holding company at this point in time may be the biggest nest egg at all. And then your clients could effectively, draw income as needed from various buckets in retirement. So I like that planning at a very high level. The other point I bring up is that if you have a client that perhaps is interested in IPP either now or in the future, they're likely going to have to pay out a greater salary than the 81,200 YMP maximum to generate that additional RSP room. So food for thought from a payment perspective. The next point I bring up then is that I'm often asked, this is great, John, I'm paying money out of my corporation in terms of salaries, dividends. How do I get money out of my corporation tax-free? How can I do that? Well, there frankly isn't many ways, of course, but really I hone on in three ways where it can be done. And that basically boils down to a payment, a repayment, or an extraction, okay? And really at the end of the day, it sounds great that there's three things that a client can do, but really in my mind, there's only really one that comes into play, and that's the payment of capital dividends. And I'll circle back to that in a second. The repayment of a shareholder loan, I bring that up because sometimes it's forgotten about, but that simply means obviously once upon a time, the shareholder, the shareholder loaned the corporation money. That can obviously be repaid tax-free. Again, typically that doesn't come into play because typically there may not be a shareholder loan to repay. But if there is one sitting on the books, make sure that's repaid if they need money out of the corporation. Sometimes, again, it's forgotten about. Same with paid up capital. The extraction of paid up capital, effectively the paid up capital can be the seed money the client put in the corporation when they subscribe for shares once upon a time. That being said, typically that paid up capital is nil or nominal, so not always an option to extract it because it doesn't really do anything without some materiality to it. So typically I usually see the repayment or extraction method, although aren't available in most situations. So then we fall back on the payment of capital dividends. And the payment of capital dividends only exists, however, if there's a positive balance in the capital dividend account. And how that is done, obviously, is through the realization, for my purpose, because I'm a investment tax and estate planner, the realization of capital gains, okay? So just like when a client realizes a capital gain personally, let's say 2/3 is taxed, 1/3 is tax-free where we sit today. Is it going to go back to 50-50? Quite possibly, but let's assume 2/3 tax, 1/3 is tax-free. Same thing happens in the corporation. 2/3 is tax, 1/3 is tax-free. That 1/3 non-taxable portion is simply notionally added to the capital dividend account. And it builds up over the course of time. And it's simply a notional figure. No money is actually deposited into the CDA, but it is notionally added. There's also a bump to the CDA via tax-free life insurance proceeds. When, say, someone passes away or the shareholder passes away, great planning from an estate perspective, doesn't do much good for you during your life, but often used from that perspective. Or when a client donates a security in kind to a charity. 0% inclusion rate when you donate securities in kind personally. The same thing happens inside of a corporation. And because of the 0% inclusion rate, you actually get a 100% bump to the CDA, which is beautiful planning for clients that are charitably inclined from that perspective. But really, most of the time, I see it from the utilization or realization of capital gains. Again, 2/3 taxed, 1/3 is tax-free. Very simple example here, utilizing a $10,000 realization of capital gains. 6,600 is taxable, the 1/3 non-taxable proportion, 3,300 and change, added the CDA, and then eventually will be subtracted from the CDA account once that capital dividend is paid out. I often bring this up in front of clients, advisors. I've talked to many clients, that have had corporations for 20, 30 years. They've realized capital gains through the sale of investments, through the sale of real estate. I often ask the question, have you ever paid yourself a capital dividend? Or do you have a balance in your capital dividend account? They look at me like, okay, what's that? Never heard of it. So I really encourage you, if you're working with your clients, to make sure that they are taking advantage of this, that they know they have a CDA balance notionally, likely somewhere available. Go back and look at their Schedule 6 and their T2s, request a balance verification from CRA so they can pay those monies out tax-free. And to actually get the monies out, tax-free from a compliance perspective, there's a couple hoops to jump through, of course. There's a need to file Form T2054, file that election with CRA, attach a copy of the resolution of directors declaring the dividend. And if it's the first time paying that CDA balance out, Schedule 89 needs to be prepared to request that CDA balance verification from CRA. So that's just, again, some stick handling to be done. So obviously, it's important to consider the compliance cost and materiality when paying a capital dividend, because there is going to be obviously some accounting costs from this perspective. Now, the next thing I like to bring up, and again, this is important, especially working with an advisor, because typically the advisor might be pulling the levers in terms of when to realize capital gains and capital losses, is that the order of operations does matter, okay? In other words, realizing a capital loss will decrease the value of the capital dividend account proportionately, just like realizing a capital gain will increase it. So really, to maximize the amount of capital dividends paid out, to get those monies out tax-free, if your client is sitting on a portfolio with both gains and losses, what you want to do is realize a portion of the portfolio first with the capital gain, right? Realize those gains first, have that amount notionally added to the capital dividend account, declare the capital dividend account or capital dividend to pay it out. And then perhaps if you want to crystallize losses, realize the losses after, right? In this way, you're paying out that capital dividend and not, having that capital loss decrease the value. So your client's not missing out the opportunity of getting monies out of the corporation tax-free. It's very simple planning, but, often overlooked. And I've talked to many advisors perhaps in the past that, didn't realize this and, erred by crystallizing gains and losses at the same time and perhaps missing the boat and getting monies out of the corporation tax-free. And really is a very simple example, right? You may have a client, they have a holding company, and they come to you someday and they say, you know what, I need liquidity. I want to buy a cottage. I need to, gift a bunch of money to my son to buy a home, but all my money's in the corporation, so I need to get some monies out. How do I do it? And that client happens to have $1 million capital gain over here and $1 million capital loss over here as part of the portfolio, some good investments, some bad investments. And really, there's two options, to do this in my mind, right? You can pull a trigger and realize all the gains and all the losses at once and kind of blow the entire portfolio out at once. But if you were to do that, the capital gains and capital losses would effectively offset each other and nothing would be added to the capital dividend account, right? Or there'd be an up and a down and that would be it. You lose the opportunity to get money out tax-free. Strategically, what should be done is realize the portion of the portfolio first with the capital gain, have that 1/3 added notionally to the CDA, pay out that $333,000 tax-free, and then perhaps realize the portion of the portfolio next with the accrued capital losses. Now, what that effectively translates into is $155,000 of true tax savings, which translates into what would otherwise be the taxable amount on a $333,000 ineligible dividend, because that would have been your only option to get the money out if you didn't enter into strategic CDA planning. So make sure you're having these conversations with your clients. Make sure they're following the order of operations properly when they're realizing capital gains and capital losses to ensure they get the money out tax-free. It can go a long way and you're adding a ton of value. Now, what I'll show you here in this screen here, just kind of, basically wrap things up in the next 5 minutes or so, is really the one main takeaway type of screen I say to clients, advisors, accountants, if you're sitting down with a client and you're building a portfolio. And what this screen is effectively, showing is, what I say is the best type of income to earn inside of a corporation. And what I say is that if you were sitting with a client and if you could wave a magic wand and pick the best type of income to generate inside of a corporation, what would be the best? And from left to right, we have capital gains, we have Canadian dividends, return of capital, interest income, and foreign dividends. So from the outset, right, we already talked about how bad interest income and foreign dividends are in terms of generating that type of income. In the bottom right-hand corner, right, or the bottom bolded numbers, we have the combined corporate shareholder tax rate, assuming the highest marginal tax rate personally. Interest income again, total tax 57.34%. Your client's paying. Foreign dividends, you're paying total tax of 63.68%. Very, very punitive. So really, you need to avoid that bad type of income inside of a corporation and really hone in on the better type of income, that being either capital gains or Canadian dividends, right? Capital gains, you have 38.23%, and Canadian dividends actually is better than capital gains today, assuming a 2/3 inclusion rate of 37.78%. Now, the capital gain inclusion rate in this particular screen, I'm assuming, a 2/3 inclusion rate. If we go back to 50/50, I have a screen on that in a second. It's much more attractive, and that's when you really want to hone in on capital gains again, take advantage of the CDA, and take advantage of tax efficiency. Now, what's the best way to do this? Okay, what's the best way to generate the best type of income inside of a corporation? Well, in my opinion, the best way to do this and to basically guarantee that your client ends up in that bucket or in that have that result is through the use of something called corporate class mutual funds. Okay, so what a lot of clients don't know is that there's actually two different types of mutual funds. Because I believe a lot of clients know what a mutual fund is. Basically, it's a collection of stocks with different portfolios, fund managers, different mandates, fixed income, balanced, equity driven. But from a structural perspective, there's actually two types of mutual funds. You can have a mutual fund trust, which really to me is the traditional type of mutual fund, or you can have a mutual fund corporation or a corporate class mutual fund. Now, a corporate class mutual fund offers some tax efficiencies over and above a mutual fund trust, in my mind. And really with a corporate class mutual fund, the way I explain it is that, think of an apartment building with a bunch of units in that apartment building. But that apartment building, since all the units are under the same roof of the same complex, there's an ability for those units to share things, right? Because every unit represents a different class of shares or a different fund, but they're all under the same roof. And because of that, our fund managers, our product tax people, what it allows us to do is take advantage of those efficiencies to share things, effectively capital losses and expenses amongst all the funds under the same roof of the same house or under the same corporation. And mutual fund trusts, every fund is a distinct entity unto themselves, so there's no ability for efficiencies necessarily. And again, so with the corporate class mutual funds, there is an ability to effectively, again, share those expenses amongst all funds and share capital losses. And because of that, distributions tend to be lower versus mutual fund trusts. And really the distribution is the excess, income at the end of the year that, fund managers need to push out to their clients or to the unit holders on T3s or T5s. And typically clients do not like distributions. They aren't, they're not looked at favorably, but mutual fund corporations tend to have lower distributions. So it's a great, selling point from that perspective. But even more importantly, in my mind, is a corporate class mutual fund also cannot distribute interest income or foreign dividends. It's fiscally and legally impossible to ever distribute that bad type of income. And remember, I talked about earlier how bad interest income or foreign dividends are. Well, with a corporate class mutual fund investment, you can invest in, say, an equity position, even with a global mandate or even with a US mandate, perhaps. But you can be guaranteed to never end up in that bad taxable position because a corporate class mutual fund will only ever distribute at year end either capital gains or Canadian dividends, or perhaps return of capital. So again, even with a global equity position, you're never going to get interest income or foreign dividends. And the way that is done, obviously, is that, at Manulife, for example, or our corporate class structure is managed in such a way that although some of our funds generate some interest or foreign dividends, we always ensure that we have sufficient expenses at the corporate class level to offset that bad type of income. And our corporate class structure has never been taxable because that results in a bad outcome, effectively bring down the rate of return of the entire structure itself. But our corporate class structure has never actually been in that position. We maintain the health of it by making sure we have no fixed income mandates. We only have a couple balance funds and the rest being more equity driven. Some of our competitors, for example, have had corporate class structures and they've been forced to shut them down in recent years because of generating too much of that bad income and not having sufficient expenses to offset that bad interest or foreign income component. However, ours has been very healthy and we can still position it as a great opportunity for corporate investing to eliminate that bad type of income and really non-registered investing as a whole for even personally held money to a certain degree. But I do love it in the corporate mandate. So love that story. In this next screen here, really, I'm just going to highlight if we happen to, fall back to the 50% inclusion rate in terms of capital gains. What you can see here, all these numbers stay the same as the previous screen, but you can see from a capital gain perspective, right, we fall back to the total taxation corporate shareholder rate to have about 28.67%. So a very nice looking number. That's effectively because the Part 1 tax or the permanent tax will decrease again, and it allows us to add $50,000 or 50% to the CDA so the client can push out more money as tax-free via the CDA. So fingers crossed that we end up in that position, but I guess we'll see what happens from a political standpoint from that regard. It's more, hurry up and wait. So really to kind of sum up things, really the 5 key takeaways from this presentation, if you're walking through some of these slides or having a discussion with your clients, again, I'll reiterate the point, right? Leave your earnings inside the corporation to invest with. Take advantage of tax deferral unless it can be removed tax efficiently or tax-free any given year. And number 2, utilize corporate class mutual funds as the preferred investment vehicle. Again, you'll never get that bad type of income in terms of interest income or foreign income distributions, and distributions tend to be lower, right? Because that corporate class mutual fund can share expenses and capital losses amongst all funds underneath the structure itself. Focus on tax deferred growth, right? Take advantage of the capital dividend account. It's really one of the only ways to get money out of the corporation tax-free. And to take it one step further, with respect to the CDA, the order of operations does matter, right? Realize capital gains first, pay out the capital dividend, and ultimately then perhaps realize capital losses next, if that was, part of the planning. And I mentioned it very briefly, right? For clients that are charitably inclined, right? Utilize a corporate in-kind donating strategy, right? The corporate in-kind donating strategy effectively allows you to add 100% of that non-taxable capital gain to the CDA, while also taking advantage of a nice, gift to a charity, get the deduction inside the corporation, and so on and so forth. There's other planning that you can utilize from that perspective through a T-SWIP with the mutual fund. We have a piece on that that goes into more detail, which really is a small presentation onto itself. And lastly, our team at Manulife, we have some really, nice handy pieces to help explain some of these concepts. They're available online. If you're looking for a little bit more intel, reach out to Thiessen, Mike, or what have you, we can flip you the pieces. Really, I like these pieces because they're really client friendly. I said they're advisor friendly, accountant friendly. We don't write in detail that is too technical. We try to write to a client facing audience, just explaining some of these concepts, the opportunity around corporate investing, corporate class mutual funds, corporate in-kind donating, buyer beware, bad foreign income inside of a corporation, all these concepts. So you're looking for some reading material or some pieces to pass on to your clients. I encourage you to take a look at those. And with that being said, I will wrap up this call for my portion. Turn it back over to Mike and Thiessen. And thanks so much for your time this morning.
All right, thank you so much, John. That was jam-packed with value. I'm definitely gonna have to play that video back to fully wrap my head around some of those concepts, but I'm sure some of those you on the call have a better grasp than I do. But I do have a couple of questions that had come into the chat. So the first one is there a specific size of business where you've seen this strategy used more effectively, or is there kind of a range for some of the accountants who have business owner clients that this is the most effective for?
Yeah, when you say size of business, you mean, I guess, investable assets, perhaps, in terms of where it makes the most sense?
Sure.
Yeah, so sometimes I'm asked the question, in terms of, yeah, how much assets do I need inside of a corporation to make it viable, versus say winding up the corporation and paying the monies out to invest personally. And typically, if you feel as though it costs $3,000 to $4,000 to $5,000 a year just to keep the corporation, up and running from a compliance perspective, tax returns, financial statement prep, or what have you. You need minimum $100,000 inside the corp at a 5% rate of return to kind of offset that cost, right? So beyond that, you need more sufficient assets, 250, 500,000 or what have you in a holding company to really take advantage of the opportunity from a growth perspective, while not being weighed down by compliance costs to keep a corporation ticking. Obviously, the more the better.
Great. I'm sure that answers that question. And then the other question I had here was, with some of the recent or upcoming potential changes in tax policy, do you still see this the solution as viable, kind of going forward? I know you kind of mentioned it at the end. You said it's a wait and see kind of game, but do you think this is something that's going to be still beneficial as we kind of go forward?
Yeah, Thiessen, absolutely. So even if the 2/3 inclusion rate still sticks, right? Let's say it becomes law, and that's what we're going to be dealt with in a go forward. Even though, in my personal opinion, as every day passes and more stuff comes out in the news, it seems like we're going to be leaning back to the 50% inclusion rate, but we don't know. But let's assume it is going to be 2/3, and that's going to become law. It doesn't take away from the narrative in terms of what I spoke about today. It's still the best option to utilize corporate class inside of a mutual fund. Because number one, it's still better than generating interest in foreign dividends, right? Regardless of where the 2/3 rate or the 50% rate, you're still going to be better off. And number two, it still doesn't take away from the narrative of investing through a corporation in general. Meaning it's expensive to get money out of a corporation, as illustrated from the get-go, right? So you're still going to be better off to invest through a corporation, unless you can get it out tax-free or tax efficiently any given year, regardless if we're the 2/3 or 50% inclusion rate. So it's not, the numbers aren't as pretty with 2/3, but it's still the best alternative than anything else.
That makes sense. Well, if there's no other questions from Mike or the audience, I will thank you again so much, John, for doing this today. Where should people kind of reach out if they want to either get in touch with you or find more information that you've put out in the past about yourself or your team?
Yeah, well, yeah, if you want more information, I shared that screen earlier with our link to our homepage. Our pieces are all posted on there. To be frank, it's typically easier to find it via a Google search as well. Just type in Manulife afterwards, and I'll pop right up. Even reach out to yourself or Mike or what have you, and we're happy to help in terms of relaying some information to accountants in your area.
That sounds great. Well, thanks again. I'm going to go ahead and end the call, and have a great day, everybody. Thank you.
Thank you everybody for attending today.
Thank you.
Thank you. Thanks, John. Take care.
Yeah.
Bye.
See ya.